everyone. We're Mortgage Pros 411. I'm Audrey Boyce-Noe with my co-host Kevin Casey, and today we are joined by Eric Morgenson with Angel Oak. How are you doing this morning, Eric?
Oh my gosh, I'm delighted to be with you guys here today. Delighted.
Of course. We just watched Eric take his happy pill, so it'll be good. Just a couple of reminders. First of all, there are a lot of auctions going on this week, a lot, but the market seems to be taking it pretty well. So far, we're in the green, so keep your fingers crossed and hang on tight. And also just a note that next week, May 16th, is that already next week? May 16th?
Yeah,
Holy
May
guacamole.
16th. Yeah.
Greater Ventura chapter of CAMP is putting on their lender fair in Thousand Oaks, and it starts at noon, and they're going to have a speaker who is going to talk about ADUs and junior ADUs, everything from the regulations to the construction. He's one of I'm not entirely clear on this yet, but he's the guy who started the original legislation that got us going in California, just in case you're in California. I know not all of you are, but there will be a panel and then a lender fair, and they always have a really great lunch, and it's just always really good energy. So get out of your houses and go do something, go meet some people and see us there, because we're going to be moderating that thing. So it'll be fun. So
Eric might even be there.
Eric might also be there. You never know. All right. So with all that being said, today we are going to do a little focus on cash out and why are we talking about cash out? Okay. So here are a few little stats for you. Ready? In the US, there are $17 trillion in tappable equity. That's 48 million borrowers who have tappable equity. Of those, 2/3 of them have credit scores higher than 760 and rates below 4%. So there are a lot of people out there with a lot of equity, but really, really strong rates on the first. We know this. In March, cash out refis were 11% of the market of all the loans done. So make sure that you're doing your share. The average LTV in the US is 45%. 45%, people. That's incredible. We are not in any trouble as far as equity goes, right? You want to make sure that you are talking to your customers, because 70% of people are saying that they're living paycheck to paycheck. That's a big number. People are in a credit crunch, even though they have tons of equity. So with that, Eric, let's just start going. You are passionate about doing second cash out to be in particular. So tell us why. Tell us what got you all fired up about this.
Well, my background is I used to have a mortgage company by the name of Nationwide Lending Corporation, and my model was literally internet leads. And as I'm taking down leads from Lower My Bills, leads from Lending Tree, leads from these lead aggregators out there, I could never pick a fight with Countrywide or B of A or Chase or Wells Fargo on an agency loan. They were doing such volume that they could drive a lower rate. So it's very competitive. But what I knew I could pick a fight with, not the middle of the bullseye, but on the periph. And I did FHA cash outs. I was doing, remember the 125. All I did was cash out loans. And I was doing hundreds and hundreds a month, sometimes 700 closed loans a month from an internet lead.
Wow.
And here's the reason I love cash out. You don't really care about an inspection report or the negotiation between the buyer and seller falls out, and therefore your loan falls out. Now, hopefully the borrower is going to go off and try to find another house, but cash out, it's a means to an end. And what I mean by that is cash out loans, you guys, tend to be more urgent than a purchase. Now, why would that be? Well, why it is that borrower wanted the cash before they even contacted the loan officer.
Yep.
So that's it. Now, how do you make money on a second mortgage, guys? Here's the real question. And you guys are used to doing first mortgages, maybe average loan size, 250, 350 out here in the land of craziness, California. These $1 million homes are everywhere, right? But how do you make any money on a second? I could walk into my credit union. I could walk in, Wells Fargo and Chase just stopped doing HELOCs. But I could walk into a credit union. I could walk into
B of A. B of A will give
B of A, that's right. And I can get a HELOC for free.
Yeah.
Oh, by the way,
for free and negative
appraisal.
Negative margins.
That's right. How in the heck am I going to make any money doing a HELOC or a second when my competition's doing them for free?
Yeah.
Huh? Well, here's what I'm here to tell you folks. Get rich on the niche, because we have loan programs that you can't get at a money center bank. You can't get
Right.
at a credit union.
Right.
These are the borrowers that are looking at dead equity. And what the heck is dead equity? That's all this equity I have in my property that I'm self-employed, and I'm taking advantage of our 75,000 page US tax code, and I get all these write-offs. So I can document to the IRS that I'm only making $12,000 a year in personal income because of my write-offs. And that's great because my tax consequence is very low. But now it's time for me to go apply for a mortgage, and I'm finding out nobody will talk to me. Why?
Right.
Full doc. I don't document enough income.
Right.
With Angel Oak and these bank statement, alt income, second DD products, both home equity lines of credit and closed-end seconds, we just go off of what the borrower is depositing either in their business checking account. That's how we document their income and making these ATR compliant. Now,
HR, ability to
ability to
repay,
pay.
Eric?
the ability to repay, that's right. Us non-agency or some people call us non-QM companies. Our paranoia is every borrower in America has a 3-year statute of limitation to sue their lender. And in this arrangement with our brokers, that's Angel Oak, for their inability to repay their primary mortgage or their mortgage on their second home. Now, goodness, we could give somebody $1 million. And if my underwriter came to work, let's say hungover on a Friday, and counted a tax refund check as income, which it's not, it's a tax refund check. It's not self-employed income, and then hit the debt to income ratio above 50%. Now that borrower has a great case to sue Angel Oak for an ATR violation. Now, in the state of Colorado, Oklahoma, and Minnesota, it's just automatic lien forgiveness.
Wow.
You don't even, yeah. So this is, but guess what? We've been at this for 10 years. We know what we're doing on bank statement income. As a matter of fact, we'll fully income underwrite and credit underwrite a bank statement loan, even if it's a first on a TBD property, often same day if we can get it before 10 o'clock in the morning, meaning you just dump the credit report, the 1003, and the bank statements on us, and we turn that around for you.
On a TBD approval.
On a TBD property, that's right. We're
guacamole.
giving you a full income and credit underwrite right up front, so you know what you're dealing with.
I haven't found a lot of lenders willing to do that. That's good to know.
So let's talk about a perfect storm for the loan originators out there that are going, oh my gosh, my volume's off 90%. Well, the whole industry's off 90%. Why aren't there a lot of purchase loans out there? Well, how painful is it that I sell my house at my 3% interest rate, go buy a slightly bigger house, is why I'm moving, because I'm kind of outgrown this house, and jump into a 7.5% interest rate? That's painful. So instead of doing that, I'm sitting tight. I'm going to Home Depot. I'm calling contractors. I'm putting an addition. I'm macking out my kitchen. I'm going to mac out my house that I'm currently in, because I don't want to touch that 3% interest rate that's in place. So that's why there's a lot of purchase loans activity out there right now. So obviously all of us know our market is down. Guess what's about to skyrocket? Home equity lending. You guys, $17 trillion out there. Millions upon millions of self-employed borrowers out there that have a low interest rate first that they don't want to touch, but boy, would they love to have access to capital.
Yes.
So why not do a bank statement home equity line of credit or a bank statement closed-end second? Now, here's how you make money on these. Our brokers are charging an average of 2 points on these, plus a processing fee. It's all borrower paid comp. Now, if I'm self-employed and I'm pulling money out of the equity of my property and I'm applying it towards my business in some capacity, guess how much of my interest rate is tax deductible, guys? 100%. No,
Now,
my first mortgage at
even if it's
3%.
more than $1 million.
My first mortgage at 3% is tax deductible to whatever tax bracket that I'm in, up to $750,000. This is our mortgage interest tax deduction baked into the US tax code. So let's say I'm in a 43% tax bracket. Well, I get to write off 43% of my 3% first mortgage rate.
Okay, just want to pause for a
Second
moment, make a public service announcement to double check with your tax professional before you give any of this advice to your borrowers or have them file their taxes based on this information. All right, keep going, Eric.
But
Because
this
also
is
I
the
clarify that Eric
simplicity
is not a
of the,
CPA. He doesn't even play one on TV, although he could with that great look he has.
Yeah, exactly.
look it up. This is all factual. So if I'm using our tax code is literally it's designed for two types of people, W-2 and self-employed. The self-employed, our tax code, our government wants to incentivize us to go take the risk and start a business. Why? Because you're creating tax revenue out of ether. Some woman or man that starts a business literally and starts hiring people. Let's say if I hire Kevin and Audrey, listen, I'm now paying payroll tax for them. And now they're paying state income tax in California, ouch, federal income tax, Social Security, Medicare out of their paycheck. So the federal and state government, it's a tax bonanza when somebody starts a business and starts hiring people. So our tax code incentivizes the creation of business and the investment into business. So with that said, that's why if I pull money out of the equity in my property as a second mortgage, and I'm applying those funds towards my business, it's 100% tax deductible.
Right.
Not complicated.
Right.
So are these interest rates higher than first mortgage interest rates? Heck yeah, it's all risk-based pricing. The higher the LTV, by the way, we go to 85% combined loan to value cash out. Wait, 85%? Never any MI on these. Also, you guys, as far as a HELOC, we have the borrower draw 80% of what the HELOC is. So we do $500,000 HELOCs, but we want them to draw a minimum of 80% at closing. Why? You're paid on basis points, originators out there. You need to get paid on that loan. On closed-end seconds, obviously it's simple. We go to $750,000 on a closed-end second. Again.
Okay, so how long do they have to keep that money before they pay it back?
There is never any prepay on any of these second mortgages.
So they draw it out and
an,
then they can pay it back right away? And is that true?
Even on an investment property, there's no prepay. But on that HELOC, we want to see that initial draw carry for 90 days.
Okay, 90 days. There it is. Got it. Got it. Okay, so let's start with HELOCs then. So give us the rundown. You already told us the max LTV is 85% on a primary, I take it?
On a primary, on an investment property, it's 80. There's people out there that have just tons of equity, again, that don't want to touch their first. Now, what if you own a property free and clear? We'll do a home equity line of credit on a first TD. You can now just have literally a draw account on your property that's owned free and clear to access capital anytime you want.
So for an investor who wanted to refinance, do a second HELOC, would they need to be self-employed in their primary job and then have investment properties to do some sort of bank statement thing? Or is there some other way that if they have a W-2 on their primary job, is there any way to go to use any of these programs?
Wonderful question. Yes, you have to be self-employed in order to do a bank statement loan. You cannot be W-2 and do a bank statement loan. However, you can be both W-2 and self-employed and do a bank statement loan. We just want to see your self-employment aspect, even though you're W-2. Let's say you work at Apple and you don't want to leave Apple because of the benefits. Oh my gosh, you even get your car detailed and the stock options. So you're never going to quit your job at Apple, but you're coding on the side over here. Well, your side hustle, you're self-employed. We want to see your side hustle or your self-employed income being at least around 30% of what you're getting W-2. So if I'm W-2 at $100,000 a year, I want to see at least $30,000 in deposits for my self-employment aspect. Does that make sense?
Mm-hmm.
I
Now,
think
do you
it
do
does.
bank balance loans? Like where
Ba-
they have enough money to make payments over 60
Asset
months,
depletion.
asset depletion.
Asset qualifiers and asset depletion, yes, we do, but those are first mortgage TD loans. We
Okay.
don't allow asset depletion on seconds. But think about it. Here's the thing, Kevin. If I have equity in my property and I got a boatload of money in the bank, I'm really not needing to tap into my equity because I have funds to draw from my bank. So we never, that scenario wouldn't ever
Well, I
play.
run into it where I've got people with money in their retirement accounts and they don't want to touch it because of the tax consequences. Or they have money in stocks and they don't want to liquidate those particular stocks because they would be facing a capital gain, a huge chunk. And when you do the math, even 11% interest is cheaper than 17% tax rate, any day. So,
So yes, asset depletion, asset qualifier on first TD loans all day long,
Yep.
okay.
not on seconds.
And you're doing cash out on those too, yes? At
Yes,
what
Yeah.
LTV?
we do cash out on everything,
Right, at what LTV?
85%.
That's the max, people. That doesn't mean on everything. Okay, so we have a note here from Catherine who says CPA here, effective 1/1/2018, home equity lines, HELOCs on primary and second residence are not deductible for federal personal tax returns. Now that law is scheduled to go away after 12/31/25, beginning 1/1/26, but rental properties can obviously deduct HELOC interest. And so again, you're talking about business purpose, because I've seen this too.
Yeah.
This purpose for the proceeds of those HELOCs. So again, just make sure you're checking in with whoever does your taxes to make sure you've got your particular situation straight, right? Okay.
Let me address that wonderful CPA. If I'm pulling money out of my personal property or whatever, and
Yep.
I'm doing a second mortgage and I'm buying a boat with it, no, it is not tax deductible. If I'm pulling those funds out and I'm applying them into my business, yes, that is tax deductible.
All
Or if
right.
you put in that boat, you're going to be renting it out and making income off it. Then maybe.
Oh, see, there's Kevin. You guys, again, our tax
Kevin's
code
never owned a
is-
boat, obviously.
Well, I know the two favorite days in the life of a boat owner: the day they buy it, the day they sell it. So
Yeah. Okay, so we have another question. Okay, no prepayment to the customer. What about EPO to the broker if they pay, like, let's say they take the 80% draw at the close and then they pay it back, 3 days later. Are you gonna ding the broker for that?
Okay, so here's the position Angel Oak has on that. There's wholesalers out there that on borrower paid comp, if that loan pays off inside of, let's say, 6 months, they go after the broker for an EPD. Well, the borrower already paid the wholesaler,
Right.
and yet they go after the broker. We
know.
think that's double dipping. That's
Yep.
not fair to the broker community, and how they get away with it, don't know. They say, well, we had cost involved in order to do the loan, but then, of course, the wholesaler is charging an underwriting fee. There's
Right.
your cost covered.
Right.
Angel Oak does not claw back if it's borrower paid comp.
Okay.
Now, if you go lender paid comp, that's a different story. We paid you up front for that loan to carry, and it didn't. So
Right.
there is a clawback inside of when the borrower doesn't make at least 6 payments, but not on borrower paid comp, folks.
Got
Now,
it.
let's talk about the initial draw. We want it to carry 90 days. Folks, we have 2 clients. We have the broker and their borrower, and then there's the end investor. And being a Stephen Covey trainer, you guys, I understand if there's ever a win-lose situation, it will always end up being lose-lose. So it's got to be win for everybody. For that loan to carry just 90 days, everybody is winning because the end investor doesn't want to see a bunch of runoff. That's not what they signed up for. So that's fair enough, just to have the initial draw carry 90. They can pay it back whenever they want. And by the way, we do recasting.
Okay.
Nice.
Yeah, if it's adjustable, you would, yeah.
Well, HELOCs are always an adjustable rate, but the closed-end seconds
Got it.
as well.
All
Yes.
right. All right. So you'll do those on owner-occupied second homes and non-owners. Let's talk about closed-in seconds for a minute. What are the options on that?
Up to 750,000. Here's the wild thing: in certain demographics, our brokers are requesting $1.5, $2 million. Guys, we'll go behind a $20 million first to do these seconds. And there's a lot of people with a lot of means that are business people, and they want access to capital.
Yeah.
They do.
That's the
Interesting.
biggest thing I run into with second loans is, oh, we don't want to go behind a large first. And by large, they mean $1 million in most cases. I'm like, oh, that's dead in the water then. So you guys will go behind a large second, and a really large second at 20 million. Or a little large.
You wait until these programs are still fairly new, so
Right.
all the empirical data is still being gathered. We're looking at an average combined loan to value, often at 20% combined loan to value. 20%.
Right.
There's look at the $17 trillion in equity, people. Let's go get it. It's just low-hanging fruit. Here's what drives me crazy. We've been doing bank statement loans for 10 years. Look at the thousands of people that have actually funded a bank statement loan. What's stopping you from picking up your phone and calling that borrower that did a bank statement first mortgage because they're self-employed?
Yep, that's fair.
Yep, I think we lost Eric.
Uh-oh, did he freeze?
Yeah, I think we did.
That's quite the
Why not
Oh, there he's
call
back. We lost you
up
for a
and say,
second, Eric.
You had frozen, Eric. That was quite the view we had there for a minute. No, your internet went and you were caught mid-air. Yeah, that's a great idea. I love that idea, is go back to your people who've done bank statement loans and see if they need a second. Yeah, great idea. You had some other ideas for where to go get these loans. Why don't you share
That's
them?
right. Now, real quick, you guys, if you're not calling that bank statement borrower that you've ever done a bank statement loan for in the past, watch out. Somebody else is going to market to them. So
that is the name of the game right now for literally everything, is if you aren't contacting these clients, someone is. And so do you want it to be you or someone else? And that it requires some people to get out of, oh, I have a referral business only. People will call me when they need something. And we need to be outreach. Like that's what we need to be doing. So it requires getting out into the world. So what are some of the places that you like to go to find loans, Eric?
well, you guys, again, the lowest hanging fruit in the mortgage industry right now, bar none, is just to contact past bank statement borrowers. It's really, a lot of people tend to overthink certain elements of the mortgage business. Guys, I like keeping things simple. It is just that easy. Now, as I'm sitting here talking with you two and anybody that's listening out there, let me ask you, who has a database of self-employed clients who are making a lot of money right now, but literally are not showing a lot of income? Who has a database of these people?
Yeah, everyone. I mean, probably
CPA.
everyone. Well, okay,
A
maybe
CPA. CPAs are sitting on a database. They have an intimate relationship.
Yep, love this post. I gotta capture that one.
I know, right? Yeah, we'll have to text it to us.
Like you almost did that on purpose.
You know what? No one should look that good when they're frozen on a Zoom call. We're taking
Eric, you
pictures
had
of
the
when you
best freeze ever. You froze again, and it was the best pose ever.
No one, I just said no one should look that good when they're frozen on Zoom. It's crazy.
Usually when people freeze, they got this like look on their face, like
Yeah, no, not Eric. He looks
eyes are
good.
looking up. No,
Guys, this is an important point I want to make, and I hope I don't freeze. A CPA has a database of self-employed clients who are currently renting, yet making a lot of money in this current wacky economic environment. Does anybody out there know of a contractor who, because contractors right now, you guys, construction, are printing money.
Yes,
They
they are.
don't know that, and they're renting. They have no idea that these bank statement programs exist because their CPAs are not that familiar with them. And literally, if any loan officer out there doesn't do their own taxes and uses a CPA, contact your CPA and let them know you have access to these programs. As a matter of fact, we have marketing that is specifically designed for certified public accountants. So you can get the word out that you have access to these programs. That's low hanging fruit.
That's the biggest thing is people don't know that these alternatives exist. So
They
for
don't.
so long, there were so few or no options for someone who is self-employed or an investor. And now we have these amazing programs. We need to get the word out. That's what we can do. And okay, so talk to us about how you look at co-borrowers and their income versus their credit score, Eric. It's my favorite thing.
On a full doc loan, Angel Oak, we have all these niches. Here's literally, I'm gonna open up the curtain and show you the secret behind Angel Oak. We're very opportunistic. What I mean by that is we've been in this market 10 years. We were doing non-QM loans before the CFPB even delineated what is a qualified and a non-qualified mortgage back on January 10th, 2014. We were doing bank statements before that. So here's what we look at. We look at the mortgage market and go, where are there missteps? Like the agency, Fannie and Freddie, let's say they tap out if a condominium complex has over 35% of the condos being rentals, they tap out. We think that's kind of silly. We don't care if the condo complex is 100% rentals, like it is on college campuses. We think that actually increases the value of the condominium complex.
Interesting.
So we're looking for all these holes out there that agency won't do the loan, or you can't go jumbo because of certain reasons. And we look at the amount of risk involved if we do that loan. And if the risk is not that great, why not offer it out there? So when it comes to a full doc loan at Angel Oak, we will use the co-borrower's income, but we don't use their credit. So we're only going off the credit score of the primary wage earner. That, you guys, we even save VA loans with that guideline, because a lot of people have an overlay on FICO on VA loans. We don't. So again,
you'll take the income from a co-borrower and ignore their credit score.
That's right.
That's the bottom line. That's great. Absolutely.
So I want to, Audrey, if I could, I just want to get back to where to find these borrowers that might want to tap in might want to know that they can access that equity, because
yes,
if I'm self-employed, I'm maximizing my tax deductions. It's painful paying the IRS more money than I need to. Nobody's happy about how politicians are spending our money. So you want to pay the least amount in taxes you possibly can. But now it's time to get a mortgage, and I've got all this equity and I can never tap into it unless I do what? I sell my house. That's painful. Where am I going to go? Or I kick that 3% interest rate to the curb and do a cash out refinance. And now I'm in the land of 7.5 because I needed to get my hands on that equity. And folks, let me tell you, we do a lot of first mortgage, literally taking out the low first mortgage rate and doing cash out, because that borrower needs that money. It's a means to an end.
Yeah. Sometimes it makes more sense.
Cheaper than having
Do not underestimate the thirst of these borrowers to get to capital. It is. And don't impose your own value system upon your borrower. If you wouldn't have done a cash out loan and kicked a 3% rate to the curb and gotten a 7.5 just to get 150,000. Who really knows what the motivation is behind that 150,000? Because folks, money to American society, to us, money's emotional. There's something behind driving that. So again, let's get to where to find these people. If any listeners out there right now have friends or have ever worked in a money center bank like Chase, like Wells Fargo, B of A, those turn downs are wonderful.
Yeah.
They are. It's a wonderful way to literally drive a truck. Now,
the trick is
listen,
getting those guys to give up those turn downs. Because a lot of them are like, oh, I can't do that. I can't share that information, blah, blah, blah. It's been more of a challenge. I used to get it all the time, and now I get more, especially the new ones who are just afraid to death that Chase or B of A will, bite back and say you're sharing company data.
You just have
so
to
let's talk
find
about
the
that.
right people.
Yep, let's talk about that. So I'm
Yeah.
a loan officer and I'm working at, let's say, Chase.
Yeah.
And I'm turning these people down, but I'm empathetic. I'm like, sorry, I can't, we can't do that. So certain people are like, okay, sorry, I can't do that. Yep, kind of gonna have to figure it out because we don't do those, and have a nice day. Then you're gonna find people that are, oh my gosh, I feel so bad. I can't do that loan for you, but Kevin can. Call Kevin Casey. His company offers those. Now, Chase allows their loan officers, if they can't do that loan, they're never going to broker. If they can't do that loan, Chase wants that loan officer to at least give that client two options. Not only can he go to, one loan officer, but here's two companies that offer those and knock yourself out. That's Jamie Dimon's policy. Wells Fargo, B of A, I don't believe they have such a policy in place. But listen, if they can't do the loan, how does it hurt that bank in any way
I know.
to
Yeah.
refer them to you guys?
Yeah. Yeah. Well, I
In
mean,
fact, one of my best ones was I had a bank that was an employee got turned down on his own loan. And I ended up turning around and putting the loan through his own bank on the wholesale side.
that's ridiculous and hilarious all at the same time. Again, guys, it's you have to just hunt for this. It doesn't mean that if the first person says no, don't take that as that's it. You keep going. That's the whole point. And so and I find this with borrowers, with people, you get one answer from someone and you take that as the gospel truth and then you stop. No, I mean, you know how we look for loans? I mean, we call 500 different lenders to see, okay, where can I fit this thing? Well, whose guidelines fit? Because not all the guidelines are the same, right? So you have one loan product and all the same and all different guidelines. So just keep at it. If it just make a list. Once you're through that list, go some more, just go, go, go.
Good point. Look at your borrower's credit report. Look at when they're turned down, a lot of borrowers like they're pit bulls. They're like, nope, I'm not taking that for an answer. And they'll shop 7 different banks and get turned down by 7 different lenders. And guess what? They're still motivated to access that equity.
Yeah.
So
well, I don't mind when I personally get a decline from a bank when I'm, on the brokering a deal. I always look at the decline as it gives me a list of reasons what to avoid on the next submission.
Okay, so you guys, I want to keep along this vein on where to find these borrowers.
Yep, keep going.
Guess what? Nobody's really reading magazines anymore, but a lot of people are listening to podcasts. And if I'm going to start doing home improvement, excuse me, and I want to, upgrade my kitchen or whatnot, I'm starting to listening to podcasts on that. It's the phenomenon. Look at what you guys are doing here. So don't underestimate your borrowers out there potentially listening to podcasts, learning about these seconds. Obviously, social media. Any loan officer out there that ever does a second mortgage, even an alt income second mortgage, get on Facebook and let the world know out there that you just did that loan, how it was structured, how much money obviously keep your client anonymous, but how much money you got them, and that you have access to these Angel Oak programs. Guys, it's just how you get the party started. And here's the reality. Slap myself around. We're in a cash out market. If you don't believe that, it's going to hurt your personal checking account. We are in a cash out market. The sooner you absolutely adapt a mindset of going, okay, I'm going to help people tap into the equity that they currently have. Oh, by the way, $17 trillion. Tap into this market. The sooner, the more healthy your personal checking account is going to be.
Yeah, I have one of those exactly right now. I just got talked about a little bit last week. Got a client who owns a house in San Francisco. It's $1.2 million and only owes about $300,000. And he wants to take cash out to buy investment property in Dallas, Texas, because he can get almost as much rent on a $300,000 condo in Dallas than he could for a 2-unit building, each unit in San Francisco, where it's costing over $1 million for that place. The return is huge. So he sees, hey, I can get more return on my money. Of course, I'm going to do cash out.
Hey, and pay attention, by the way, to the comments that your clients are making, because I caught one of my clients recently, and we're doing a purchase, and he's done another purchase on investment properties, and they were higher rates for sure. And so he made the comment the other day, he goes, yeah, so I'm sure I'll be able to refinance into 6 something. That'll be great. And I thank God was actually paying. I'm like, no. I said, listen to me, that is not going to happen. Like conventional rates, hopefully they'll get back down there. Non-owner rates, let's keep it real. And I just walked him through like the likelihood of that happening. Don't expect it. Just make sure you are really direct with people and give them a reality check on what to expect, what's coming. And, and at some point, maybe they'll be able to combine the first and seconds that we're doing now together and get a lower rate. I mean, I pray that's coming, but boy, I feel like we keep pushing that down the road as far as it being an option with the way things are going with the economy and the Fed, et cetera. So with that being said, just make sure the expectations are clear and just let them know that expecting rates to get down. I have clients who have investment property rates in the 3s. We're not going to get there again. That's not going to happen. I mean, the LLPA
Generational rate.
yeah, that was okay, the world just caved in on itself and you got that. So that's it. Don't sit around expecting that again. It's really important that we are helping people understand that. So yeah. Okay, somebody asked whether you can do new construction, manufactured homes, with those kinds of loans.
So you can cash out and do whatever the heck you want with that.
Even on manufactured?
No, these programs are not for manufactured housing. This
Okay.
is strictly 1 to 4. We allow high-rise condos. Currently, our second mortgages are only for warrantable condos. However, all of our other programs, you can do non-warrantable condos.
Okay, so you're following Fannie Freddie guidelines when it comes to warrantable condos?
Yes.
On the seconds. Okay.
Only on the seconds currently. And the seconds are a month old, you guys. So with that said, we have yet to do our first securitization on this product. Once we've done a mortgage-backed security, Angel Oak is a broker dealer. So we're like a Bear Stearns or a Merrill Lynch. We put these things into securitization, right? So
Wow.
once we've done our first security, then we're going to go to the investment community that bought into these and go, look at what we missed out on. How is your appetite on these guides?
Right.
And that's where you start seeing the guidelines expanding. So if we give you, if it's a scenario we can't do today, database your client because these guidelines constantly are expanding like a balloon.
Oh, that's good to know. Yeah. All right. So
Now
yeah.
you do this as a straight up second, or do you also do it as a HELOC?
Again, standalone seconds and HELOCs, one or the other. Standalone seconds, $750,000 loan amounts. I anticipate we're going to get to $1 million pretty soon on that. Second, or the HELOCs are $500,000 today.
Can you give us a range on the rates? Like, are we talking about 16%? Are we talking about 11%? Are we talking, give us an idea on rates?
Yeah, we're looking at the high 7s all the way into 11.5.
High
We don't
sevens
charge
on a
any
second?
points. I'm sorry, go ahead.
High seconds on a second?
Yeah, high 7s, low 8s.
Wow.
It's all risk-based pricing. The better here's the weird thing about lending that always I never really understood this. Okay, the higher the LTV, the more risk. The higher the FICO score, the less risk. But what about debt to income ratio? What if somebody's got a 7% debt to income ratio versus somebody else that's got a 50% debt to income ratio, but that pricing's still the same? DTI doesn't seem to have a bearing on that. But
It's
Because
amazing, isn't it?
MBA says that there's very little correlation between DTI and delinquencies. But I would imagine that if your DTI is 7%, that might tell you a little something, right?
well, that's a borrower that almost doesn't need a loan.
Right.
Yeah.
So
That's the one I had yesterday.
I do want to do a recap real quick. Loan amounts, a minimum loan amount on a second is going to be $75,000. Folks, and I know that's not a lot of money to be made on a $75,000 loan. How about but a lot of referrals to be made on a $75,000 loan?
Yes.
These rates are 30-year fixed, 20-year fixed, 15 or 10-year. You get to pick. It's the same rate, so why not just do a 30-year to give them that payment, because there's no prepay. Always offers them a lower payment. This is for cash out or rate and term refinance. We get people out of sometimes hard money situations, owner occupied second homes and investment properties, non-owner occupied. We do these on single family, townhomes, 2 units, and multiple condos. Now we'll use either 12 or 24 months business bank statements. This is not a personal bank statement loan. This is not for the sole proprietor, self-employed borrower out there that we can do traditional bank statement loans for. Folks, these are business bank statement alternative income second mortgages. We'll do these both on full doc, 1 or 2 year tax returns, even a P&L. We'll do these. The minimum FICO score is going to be 700 to do cash out on these. So the DTI, we go 50 front, 50 back end. The owner occupied program for these, not available in the Lone Star State, Texas. We all know about Texas and the Constitution in Texas that protects home ownership equity. So no bueno in Texas. And for these programs, they're only allowed in Tennessee if it's an investment property. You cannot do owner occupied in Tennessee.
All right. Well, and
Do it
let's
on investment property, which is impressive.
Let's go back to the idea of doing these little tiny HELOCs. So I just closed, actually my only loan I've closed this year that wasn't private money, it was a $50,000 HELOC. And let me tell you something, my processor was not excited about working on this at all. I had to I kept going. He would just start. He's like, he literally one day, when it finally closed, he sent me an email and it was a picture of the front of a dollar store. And he goes, enjoy, you can spend your commission here. I mean, I made no money. That's a given for sure. And it was a lot of work, just for the record. However, my clients are young and they have 2 babies and they bought their house. I don't know. It's longer ago. It was like 2 years ago, maybe. And they have a bunch of friends who need to buy houses, who want to buy houses, who think they can't buy houses. And guess what? They think I'm great. So I want to make sure that I'm doing the right thing anyway. But in this particular case, like I just did something that they'll remember, right? So just think past, yes, I know it's no money in that $50,000 stage or $75,000, it maybe, but it's worth it. It really is worth it. And it's not like we have loans falling out of the sky right now. So take what you got. There was a poll on LinkedIn, I don't know, a week or 2 ago, where people were asked, the likelihood that they would do a second or a HELOC. And it was so funny because most people said yes now. And I'm thinking, oh my God, 2 years ago, the answer would have been a landslide, 100% nope. Nope. I mean, we just avoided them like the plague, but now it's an opportunity. Look at it as an opportunity. All right. With that being said, someone's asking how they get approved with you, Eric. So Do you want to give them your email address?
Please, yeah, you can you show them my contact email
I
or
cannot.
my
We'll put
cell
it.
phone? I'll just let you know my cell phone number. Anybody out there, call me. It's 949-554-5000. Once again, that's 949-554-5000.
We'll put your contact information into the YouTube channel we'll embed it into the video. So they'll be able to find it there too. So yeah, we have.
Or if you go down to the Greater Ventura for their event next week.
Oh yeah. Oh, I know. Peaches posted that Angel Oak's a premier sponsor at her Lender Fair. So
What are
good
we
job.
not a premier sponsor?
What?
When are we not a premier sponsor?
Yes, very supportive of the mortgage industry. Very good. And Eric was a longtime member of the board for
Camp.
I know camp. God, I was trying to figure out which chapter. OC, right?
LAOC, yes.
Yes. Okay. Great. All right. So yeah. So there's again, the whole point of all of this is there's so much opportunity out there for all of us. And just sitting around waiting for the rates to come down is madness. I mean, we've been saying this for literally years. We have video evidence of this. So please, please, please use some of these tools and programs to go help some people. It would be so, so good. Meanwhile, back in Bandcamp, Black Knight and CoreLogic came out today with their home price appreciation for March. And we know that CoreLogic is very conservative. They're very, very, very accurate on their data, but very conservative in their estimates. Both of them came up with home price appreciation in March up 1.2%. That's for 1 month, people. It's 3 times what CoreLogic thought their home price appreciation was going to be for the month of March. So they have since increased their year-over-year estimates from 3.1 to 3.7% appreciation. We think it will probably end up being a little higher based on what we're seeing. And they're expecting a 0.8 increase in April. So these are really good numbers. The market is super, super solid, super solid. Oil prices are down $10 a barrel. So I found this really interesting because in the past month, they've come down $10 a barrel to about just under $78 a barrel. And I keep thinking that somebody needs to call my gas station and tell them that because my gas prices are still so insane.
I went down by a dime.
A dime?
A dime, yeah.
Really? So $10 a barrel equals one dime.
Oh, no, I bought some extra. Just
Oh my God, I just thought that was crazy. So yeah. Anyway, rents are down, even though our inflation numbers keep showing that they're up. There is manufacturing's in contraction. Services are now kind of easing off a little bit. It is not quite as robust as it was, which is very, very interesting. Realtor.com for April says that their active listings went from 695,000 to 734,000, which is an increase month per month of 5.7%. But think it's that's April, right? It should hopefully it's doing that, for God's sake.
This is when we sell most of our houses.
Exactly. So again, when you're not doing cash out refinances, you should be getting a piece of the 4.1 million sales that are done each year or expected this year. 5.2 million is what is expected or normal, but that's not what we're going to get probably this year. However, 4.1 million, that's a lot of sales for us to be doing. So even if a third of them are cash, 20% of them are cash, that's still a lot. There's not a lot of LOs left if you're listening to Barry Habib and their estimates of the numbers, right?
I can tell you from our database, it's like, wow, where are they all going to?
You know what?
So listen to Audrey. She's talking about purchases they're declining, but guess what is skyrocketing? New business license applications. So since COVID, there are so many millions of Americans out there that are starting a business. And when you first start a business, boy, do you ever have startup cost. And normally you're not that profitable and you have a lot of write-offs. Well, a lot of people are profitable right out of the gate, and the marketplace for these loans are going up exponentially. Not to mention equity keeps rising. in
Mhm.
residential real estate. So
Yes, it
we
does.
have a perfect storm for cash out seconds. It's perfect. Get rich on the niche. You can make a fortune on these loans, a fortune.
So that actually brings up a good point. What do you consider to be long enough in self-employment? 2 years? Is it more,
Um,
is
uh,
it less?
Go ahead.
Is it more or less than 2 years for if to consider with someone self-employed?
We'll do a 1-year self-employed bank statement loan. On these seconds, we want to see them self-employed for 2 years.
Okay, so do you provide 24 months on somebody who's 2 years in the business?
No,
Wait,
you
hang
can
on,
do
hang
12
on, hang on,
months.
whatever. Do you, okay, hang on. What did you just say? So the 1 year self-employed,
That's cash out.
yes,
But
Guys,
second,
we will do a first mortgage with somebody that's self-employed for 1 year.
got it. Thank you.
On the seconds, we'll
First,
do a self-employed borrower has to be self-employed for 2 years on the guides today.
that's
That
real
could be
simple to
changing.
remember.
thank you. The
First is
visuals were
1
very
year,
helpful.
and first is 2 years, 2 years. Second. First, 1 year, seconds, 2 years. It's so simple.
That reminds me, wasn't that the Rob Christman joke? A Roman walks into the bar and says, "I'll take 5 beers." Get it?
Listen,
Roman
you
numeral
missed the
5?
The
Roman
Roman
numeral
joke, yes.
5.
Yeah.
I thought that was funny, no?
I thought you said a robin, like a bird robin.
Oh, no,
No,
Rob Christman,
Roman.
sorry, Rob Christman. I think that was one of his jokes in his commentary. A Roman walks into the beer and says, "I'll take 5 beers." I don't know, I thought that was funny. All right, just another news, just because this always just irritates the living crap out of me. Fannie Mae's profits grew to 4.3 billion with a B in Q1 2024. Yeah, that's while everyone else in the mortgage business was just sucking wind, Fannie is killing it. So we got those LLPAs to thank
That's
for
because
that, I
they're,
guess.
they're paying off and making everybody pay off their loans.
Oh my goodness, crazy. Eric, do you have any comment on the Fed's comments that Jerome Powell spoke the other day after the Fed meeting last week? And they are going to slow their balance sheet runoff. Did you see that?
I did.
Yeah, what do you think? Good, yeah? Potentially, maybe, fingers crossed.
I think it's positive.
Assuming nothing else happens in the world that, throws that into a tailspin. But that should start in June. And he also said, which I really liked, because they really, when he's making his comments and the reporters are all in there, and I watched the whole session. It was really interesting because they kept coming at him. Frankly, a lot of the questions were a little dingy, but whatever. And they kept trying to get him to say certain things. But one of the things he did say clearly is that he didn't think that the next move the Fed makes will be a hike, because there was a lot of speculation out there that maybe that was going to happen, that maybe because the inflation numbers have been stronger than anyone wanted to see, maybe they would be leaning towards that. And he was like, yeah, no, I don't think so. And also he kept saying that, their current policy is, and I quote, appropriate. So anyway, it'll be interesting to see how that goes. He doesn't seem to think that stagflation is an issue. We had heard somebody talk about that a few months ago, and we'd asked a few times different economists, and so anyway, so I don't know, fingers crossed, it looks like we're going in the right direction.
Audrey, what do you think about this election year and what the current administration is going to do with interest rates leading up to the election? All indicators are they're going to be bringing them down and saying, hey, look at how good we are. Interest rates are down. Everything's going to be great. So with that said, if interest rates do come down, property valuations are going to go up. More people are going to be fiending to buy homes. And on these second mortgages, we're anticipating, an ample amount of runoff. It's all baked into the rate.
So if you listen to Jerome Powell speak last week, you will hear him very, very clearly say they have absolutely nothing to do with politics. They are not going to be influenced by a president or anyone else, and that they're going to make decisions based on the data. They're data driven. So they are really, really, they really bang away on that point. it's interesting because when we started the year, the forecast was for, I've lost track because we were supposed to have a ton of rate
Big reductions.
decreases this year.
Yeah.
And then like in the last month, we went from thinking it was going to happen in June to maybe it's not happening at all when we had Dr. Yoon on from National Association of Realtors, their chief economist. But he was like very cheerfully with a big smile on his face. He goes, but don't worry, then they'll happen later. And I'm like, oh my God. So anyway, but then the last few days, the data has shown that maybe things aren't as bad. So again, I am so over the rates, Eric. I am just like, I want to close loans. That's it. What can we do today? The appreciation is strong. What are we able to do to help our borrowers create, generational wealth, to have a home to live in? What can we do around that? And the rate is the rate. Can I make the payment? Can I afford the payment? Is it going to cash flow? Is it a good investment? Is it a good business decision? Not what is the freaking rate?
Well, we don't sell rate, we sell payment.
Right. That's
With these cash out seconds,
amen.
it's
And cash
such
in your
an
hands.
underserved market. It's not being served.
Yeah.
It's so underserved right now, folks. You can make a fortune on this, a fortune. What else are you going to do? Hard money's doing great, so you're probably doing private or hard money. But what else is there? Huh?
That's right. Yeah. Okay. Somebody asked, do you need an NMLS number to do 1 to 4 business purpose loans second with you? You need an NMLS number?
Yes.
Yes. Okay, great.
Are
And
they only licensed with the DRE? Call me. We have workarounds. We also allow loan officers who are licensed in California to do non-owner occupied property DSCR loans out of state.
that's
If
a
you
really
stumble
good story
upon
to remind
those.
people about. Okay.
Yep, we're truly a national company.
You do
And-
Texas
Oh boy, do we ever do Texas.
with that program?
When you say that program, by which
Program
one
or
do
a
you mean?
DSCR on a.
Oh, yes, sir.
Not licensed there, yeah.
He wants to know whether he needs to have a license to do a DSCR loan in Texas.
Oh, thank you for that. Okay, so Texas, let me just see if that's on the list of 16 states that it is allowable. And the Lone Star State is not such a state.
Go get your license, Kevin.
I'm
Don't
going to get my
shortcut
license.
this thing.
Colorado is, Florida is,
Yeah.
Georgia, those are pretty big popping states right there.
Yeah,
Okay.
Washington is on that list. Those are high loan amounts as well.
yeah. It's been nice. It's a nice little niche. It's really funny. I've had a few clients come and it's like, oh yeah, hey, and I look at a sweet, we can do that one. So
It's good, isn't it?
yeah.
Jill confirmed that it was in Rob Chrisman's commentary, the Romans joke. I was just like, nobody else thinks that's funny. How is that not funny? God,
Yeah,
not even
delivery.
one,
All in the delivery.
Is that what it was? It was my
Yeah.
delivery?
Yeah.
Oh, that's kind of sad. Okay. So anyway, and just in other news last week, we had the BLS jobs report, which everyone who listens to this regularly knows that I prefer to call it the BS jobs report because it's always so flawed. However, they missed expectations. What a shocker. Revisions down for previous months, and the unemployment rate went from 3.8% to 3.9%.
Hey, Eric, can you get us a list of the states that you can do DSCR loans and we can add it to the YouTube video?
Oh,
Yes,
that's
sir,
a great
sure
idea.
will.
Oh, that's a very good idea. I like it. Yeah.
Beautiful.
Anything else you want to throw in there, just let us know. So
Yeah.
with that being said, kids, we are, thank you, Anthony. Anthony says he thinks all my jokes are funny. So I appreciate that, even though he might be full of crap. So with that, I hope you all have a wonderful week. Eric, thank you so much for joining us today. Call him. We will provide his phone number to anyone who missed it before, and go get some loans. Go do some cash out. Go get some seconds. Go do something and close some loans.
Help get the word out. These programs exist and
Yes.
go to the bank.
Yes. Borrowers are paying 32% on their credit cards. They'll thank you. All right. Have a good one, guys. Bye.